Is the dollar's role as a global haven currency fading? US dollar staged a muted rally against major peers on Friday in the aftermath of Israel's strikes on Iran. But those gains soon faded and ended the week around 1% lower. The reaction was a far cry from decades past when international crises would typically fuel gains in the greenback, long considered a safe haven. Jeremy Stretch is Chief International Strategist at CIBC Capital Markets. So, Jeremy, is the dollar's crown now slipping?
Well, certainly the crown, I think, is a little tarnished. I don't think we can necessarily say it's absolutely slipping, yes, but I think in the context of the performance that we've seen, not just over this immediate crisis in relation to Israel and Iran, but over the recent weeks and months, that international investors, I think, are starting to question the role or the dominance of the US dollar within the global financial architecture. It's not the case that investors are actively and significantly divesting dollar holdings yet, but they are questioning the maintenance of those thresholds and potentially looking at alternative markets in terms of currency flows and asset classes. And I think that's going to be the theme that is going to predominate as we move forward.
Let's move closer to the escalating Middle East tensions. Analysts predicting crude prices could propel to as high as $130 a barrel. So will the dollar follow higher?
Well, of course, oil prices are very susceptible to external risks, and the ultimate external risk would be some degree of supply shock, and in particular in relation to the ability to transmit flows through the Straits of Hormuz, which, of course, Iran could potentially blockade. So if there were to be such a scenario, then clearly oil prices would continue their exponential hike higher. But I guess the problem with them would become in terms of the impact that that would have in terms of inflation expectations and or the propensity of the Fed to be able to cut rates. So in a sense, you would argue that it should be beneficial for the dollar in terms of that safe haven premium. But I think outside of perhaps crosses like dollar yen, which could be susceptible to upside risk because of the importance of oil or an imported oil to the Japanese economy, it may not be quite as straightforward a dynamic in terms of expecting the dollar to appreciate under such circumstances.
So you mentioned the Fed there, Jeremy, and all eyes on Wednesday for their decision. What are you expecting?
Well, I think Chair Powell, of course, is in a very invidious position because he's getting external pressure from the White House in terms of too late Powell. But I think from a Fed perspective, there are a number of uncertainties which make it appropriate to maintain a degree of optionality in terms of the policy narrative. Now, before the recent events, the market was starting to was fully pricing in a rate cut as early as September. We've taken a little bit away from that now, but it is still the case that the market is still pricing in a relatively elevated propensity for rate cuts beginning in September. But I think the chair will want to try and maintain a degree of, as I say, optionality, underlining that inflation risks still remain elevated, but perhaps starting to focus a little bit more in terms of the labor market dynamics, because I think that's quite interesting. Because if you look at things like continuing claims within the jobless claims series, they're now at a 4-year high. And I think that employment component of the Fed's narrative could become much more instructive in terms of the policy narrative as we go forward.
As well, taking advantage of that weaker dollar, the pound up almost 9% this year. Could this prompt quicker easing from the Bank of England even as soon as this week?
In a short word, no. I think there will be a couple of voters who will no doubt advocate an immediate rate cut, as they advocated for 50 basis points back in May. So I think Dingler and probably Taylor will advocate for immediate policy easing. But I think the maintenance of the narrative in the most recent policy communications about gradual, I think suggests that the bank is going to remain very receptive to that notion of moving once a quarter and not accelerating that. Of course, there are a number of cross currents. Not least of which in terms of wage growth, which for many on the MPC is probably still inconsistent with their inflation target. So I think that still favors a cautious and graduated approach. So we would expect the next rate cut to come in August, but then that would be then followed up only in November by further easing. So the pace and pathway of once a quarter policy easing from the Bank of England, I still think remains very much in play.
That was Jeremy Stretch at CIBC Capital Markets. Don't forget, you can watch more videos on Reuters.com.